Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. And our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Last week on the show, we focused on finding a short put spread on XLV. And since earnings season is getting underway, today we're going to use our stock scanner and option scanner to find an earnings trade. Matt, if you're ready, do you want to share your screen and go over the trade from last week?
Sure thing. You see it okay?
Yep, looks great.
All right, great. All right, so last week we put on this is our paper trading positions here. We also, as you say, integrate with Tradier and other brokers, but we have a paper trading account here, so we could go test these trades out. So we put on this short put spread, as you say. We sold it for 58 cents. And then currently in the market, it's 11 cents. So, it's 138 we sold and we bought the 136s, 58 cents as we went over last week. So that's another good trade, Tyler. We're on a pretty good roll, huh?
Awesome. Yeah, so far, so good.
All right. So this week, earnings. So, you know me, I like to buy earnings usually, but also selling them using calendars. Maybe we'll get into that next week. But I want to find this week a stock that we can buy a straddle in, and a straddle is the simultaneously buying a call and a put, and generally the stock needs to move more than that straddle is worth. However, you also have some residual value for that straddle depending on how much time you have and how much volatility you have. So we'll start there. So you ready to go, Tyler?
Yeah, so we have two ways to look at earnings. A few ways to look at earnings in our dashboard, but let's start with the market intelligence. So this is where you can see sort of all the earnings coming up for the next week, and it's broken down by day, and then also broken down. They're sized by the average option volume over the past 20 days. So you're going to see some of the big stocks, larger in the chart, and then some of the smaller stocks, a little smaller in the chart. And then the color is the average implied less than or greater than the average actual move. So a stock that's green has the average implied move less than the average actual move, and then the red is where the implied is more than the actual. And what we're talking about there is earnings moves, as in the implied earnings move as dictated by the options market.
Right. So Netflix is very green here, and so the implied move this earnings is 7.2, and it's moved about 11.9 average. And how do we come to 11.9? We could go to the earnings, type up Netflix, and take a look at these averages underneath here. We have the average actual move. So back to January 21, 16.9% up. So you could see here the implied move was in green here, and then the actual move is the dark green dot. So you could see how kind of quickly how many times the actual move went outside of the implied move, and then we average that up. So here's that 11.9, Tyler, and here's 7.0. It's a little bit different than on this, but there's that relationship. So this is one way to look at get a good history of earnings. And we also have some earnings per share information, and then also revisions. So sometimes people like to look at that as well.
Yeah, another way to look at this is when the average implied move is more than the actual, then that's better for short straddles. Is when the actual move is more than the implied, then that's better for long straddles and strangles.
Right. And And you could also, you could search for those too. So you could, all those things that you're talking about, Tyler, you could go into the stock scanner and then have a method for scanning for these.
Great. So what are we looking for today? Are we looking for a stock that we want to buy into it, right?
Right. So, ORATS has a ton of data. I'm not a programmer, but I'm dangerous in Excel, and I kind of came up with my things that I look for. The forecast earnings effect divided by the implied earnings effect I look for, and then also we have two looks at earnings moves. Our old one is kind of a macro, doesn't really net out a lot of the earnings, but the implied earnings move does. And I found that is actually a pretty good indicator of valuation. So those are the two things I like to look at. So that ratio, so I try to find a high forecast earnings effect divided by what's implied in the market. And I try to find a high implied earnings move dividing by the actual earnings move. And then, it's a little bit hard to see, but here's one, 6.68 and 1.63. So that's MTB. So that's, let's take a look at that. That's M&T Bank Corporation. So, banks have been in the news and they're important. So this might be a good one. Looking at implied volatility, X earnings, actually looks pretty good. It's underneath where some of the XLF is the Spider Financial ETF. So what we do is we take the weighted average of all the components in that and compare it to MTB. So the volatility looks decent. We'll go back and look at this earnings. It's ended up outside of the earnings implied move. Sometimes when you don't see an implied move, we didn't have a dependable move that we could display. And so, the average move is 4.6, and right now it's implied at 3.9. So that looks pretty good. Let's take a quick peek at the trade builder. I want to see the implied volatility. It hasn't really peaked up a whole lot, so I like that. So I'm going to look for a way to profit from a bigger than implied move in MTB. Tyler, how does that sound?
Yeah, that sounds good. Before we jump into that, can we go back to the stock scanner and just go over a little bit, slower how we found this, and let's look at the indicators. I'm curious what this forecasted earnings effect, how we calculate it, why it's important.
Now that's a funny story because that's one of our oldest indicators, and we would that's actually a different way to look at it. So the forecast earnings effect, implied earnings effect. So we would look at the earnings effect above expectation. So what is implied in the market. Here's what's expected, and then we would solve for a rational skew after earnings. It's kind of hard to explain, but in order to get what the implied earnings effect is. And then when we started developing the implied earnings effect, we said, well, is there a way that we can forecast that? And part of it is a seasonal, how much does this particular stock move at earnings, in January? Part of it is last year. Part of it is all of the expectations. And we do some adjustments with implied volatility as well. So that's how we come up with our forecast earnings effect, Tyler.
Okay, so the earnings effect is sort of the term that we use to describe what happens to the stock as we approach earnings. It's kind of the additional implied volatility.
Yeah, what you just described is the implied earnings effect, and the actual earnings effect is what I should have been describing there. So the actual move is the actual earnings effect is what we're trying to predict. And it's a little bit different from the actual move. The earnings effect is how it moves over the kind of X earnings implied that we had before. So is there a greater than normal move? And that kind of tends to normalize things. It's a little bit hard to describe, but that's so there's an implied earnings effect that's over and above what volatility is going to fall to after earnings, and then there's an actual earnings effect that actually happens that you could observe after earnings has come and gone. And so we measure kind of two ways to look at. We look at earnings two ways. One is just what the percentage move is and what the percentage move that we kind of teased out of implied volatility. And the other is the earnings effect, which is kind of the additional move that the stock will have at earnings, if that makes sense. So there's two ways to look at it. So it's I think it gives us a little bit of an edge. As a matter of fact, I did some back testing of it. It's done pretty well. Maybe we'll have our own show on just how to go through and compare the moves that actually happen, the moves that are expected by implied, and because that's really what you're trying to identify, and then try to find a good trading strategy that profit from that, which is our next step.
That was a good explanation. And we also have some blogs on this information as well. So you can find that on orats.com/blog. So we have a lot of indicators around earnings and taking out the earnings effect. It's how we calculate a lot of our volatilities. But I just wanted to sort of go over that more just to get a little bit more in depth on our indicators that we're using to find these stocks.
Yeah, and like I said, these are, we probably have on a 15 or 20. And we have endpoints in our API. So APIs is where we keep all our data. And just from being market makers and stuff, we've kept putting different ways to identify earnings effects, earnings moves, implied earnings move of the front month or the back month. So there's a lot of information that we have in there. And then what I do is just take it all, line up a bunch of actuals and what are the big differences? Because you want to identify the big movers compared to the small movers. And so, these are the things that floated to the top for me. Of course, anyone else using other methods like that or machine learning or something, they might come up with different indicators, but that's the power of ORATS is we have this data all the way back to 2007 and a lot of data there to test it in our APIs.
Great. Do you want to share a screen again? And it looks good. So you found stock for a bank, so MDN or
MTB.
MTB. Okay.
Yeah. Could you see my screen? Okay.
Yeah, it looks good now.
Okay. So first thing, we go to the option scanner, and I typed in MTB here already, and then we're looking for long strangles and long straddles, and I spread out the days to expiration a little bit, so we could capture more. This isn't a huge number of option stocks. So this is as a reasonable amount of stock. So you kind of have to widen out your deltas and widen out your days to expiration in order to get as many results as possible. And then we'll show you how I go through and sort through those. So strangle 30 delta calls and puts. The straddle is 40 to 60 delta. And then you could set other relationships, but that's all I set. So then when you do that, we come up with 6 results based on that. Those based on the delta constraints and the days to expiration constraints. And then you could rank these based on various things. We have these theoretical values that we've explained in varying degrees of depth and other presentations that we put on. But basically the S is a smoothing. So we just draw a smooth curve through the whole month. And so that's usually pretty contained, plus or minus 1 or 2%. So that's not that big of a deal. But then our forecast, we talked about forecast of the implied or forecast of the earnings effect earlier. Actually, the forecast has that baked into it, along with forecast of volatility and forecast of long-term volatility. So that's one of the things I like to look at. So I could weight these, and then so I'll weight that, and also distribution is how much the stock has moved historically, and then we put those into buckets and come up with that expected return for each one of these straddles and strangles. So let's take a look at the top rated one based on these weightings. So I do reward to risk and probability of profit. So let's just look at that real quick. So reward to risk. So here's a probability of profit. So these are pretty small probability of profits. They're not really adjusted for the earnings moves, but let's take a look at that. The probability of profit is the area under the curve of the terminal value of the payoff picture. So a payoff picture looks like this for a straddle. So you have your call and put here, and then it has to go up to a break even of 145 or down to a break even of 124. And then it turns green, and that's where your profit is. So you can maybe see behind these are probabilities behind each one of these distributions. And so the biggest distribution is near the money, and then the biggest, the farthest away, they get smaller. That's just like stocks don't move in a normal distribution, but some of them look like a normal distribution. So that's what the distribution looks like. They only have that worth 767. But one of the things that we don't do with the distribution is we don't, like I said before, we don't have an earnings only distribution, so it's not as valuable. The forecast is much more related to the earnings. It has that built in with that forecast earnings effect, and then the smooth edge, as you can see, is pretty close to where we are in the market right now. So so that's one. So it has, this one has to travel, pretty good amount. So, so it's February. So even when this earnings has gone and the stock has moved, there's still gonna be a lot of premium left, just because there's a lot of time left in this straddle. But that's a pretty expensive straddle, $1,000 to pay for one lot. And then it has to go pretty far. 10% is up is 146, so it has to go almost up 10%. When we saw that, our expectations probably more around 4 or 5%. So let's look at another one. Maybe that will come up. Let's look at how a strangle looks. So those are two straddles. The best strangle is this one, the 130, 135 with stock 131.75. So it's less expensive, but the probability of profit is actually pretty close to what we saw with the straddle. Reward to risk, again, we have it worth $7. This isn't that exciting. And then so what I might do is and here's the 130, 140, a lot cheaper. And then this is Jan 19, so that only has 3 days left. I kind of feel like volatility is pretty reasonable. So and we think it's going to move a fair amount. I'd rather do a wider straddle or strangle, I should say. So I'd be choosing between one of these two. It's pretty difficult because again, one's below the market, one's above the market. Let's just take one more peek at it and see which one we like better. That one has a 15 delta. Let's just check that out. It might be too much of a delta. And again, you could filter these deltas down too, but so one's long 15 and one's short 15. So let's go with the long delta play, Tyler, just because we kind of talked about last week too, that when volatility goes up, when the stock goes up, volatility usually comes down. So if we're leaning a little bit long, I think that's the way I'd go with this. So this is the choice I'm going to make. Not as expensive. We have some time left. It's in February. Volatility is decent. So yeah, I like this trade. What do you think, Todd?
Yeah, that makes sense. I like the longer delta on that. What do you think about exit alerts? Are we, looking to hold this till expiration through the earnings date? Obviously.
Yeah, that's a good point. Obviously we're going to hold it through earnings, um, and which is in a couple days. So, and then I think you take a good look at it then, because this isn't really something I want to kind of hold on to. I'd rather get a good pop and see what happens. So
Yeah.
so I would say don't really need an earnings alert other than just you could put an event in there alert one day after earnings day just so you can
Yeah, check it
alert
out.
yourself.
Yeah, I think that's a
Yeah.
good idea.
So paper trading, and then I put Tradier Hub, and then show it, and then let's send it out. This one should fill again. We have it worth $5.91, so we're given what we think is about 10 cents of edge, which is a lot. So we could wait for this to fill in our simulated environment, but I'm just going to force it. I think that's pretty valid. And so we'll send this out, $600 trade, and let's see if we can continue it, continue our winning streak.
Great. Yeah, we've done pretty good on the most recent trades. I think we did good on the last one too. Uh,
Yeah, I mean the thing about earnings is you might not win that much on this one. The probability of profit's a little bit lower, but if you do win, some of these are big home runs. So that's what I like about some of these earnings trades.
Great.
All right, that's what I got. That's what I got for you, Tyler.
Cool. Yeah. I think that that's about everything for today. I mean, we covered a lot of indicators in the stock scanner. We dove into depth on that forecast earn effect and all the earnings indicators. Perhaps we'll have another show on that soon. That sort of we can dive a little deeper into the calculations of those. I think they're very big part of ORATS.
Yeah, good point. I mean, we have hundreds of these indicators, and we have a good page on our dashboard that explains those and shows graphs historically of those methods. So I think it behooves you to get and traders to understand what's going on, and also we're doing some more kind of machine learning, and so the more indicators that you have in there, the better, and especially if they're well calculated, consistent, and have some predictive value. The machine learning could start to identify those as valuable predictors for it. And that's the way I did. I just did it kind of by hand, but I looked at thousands of different trades, and those are some of the best predictors that I found. But I didn't do any machine learning, formalized study on it, but that might make sense to do as well, Tyler.
Yeah, I agree. That's some exciting stuff coming up. Well, yeah, thank you to Tradier for hosting us again and letting us demonstrate how to use our earnings tools. It's earnings season, so we'll probably show some more earnings stuff coming up in the next few weeks. But until then, see you guys next time.